Have you ever wondered if the taxman has a secret weapon? A magic trick to know when someone's books are, shall we say, creatively written? Well, it turns out he does, and it's not some dark art. It's just simple math. A man named Dr. Joko Ismuhadi came up with two brilliant, almost insultingly simple checks to spot financial shenanigans. These aren't complicated algorithms that require a supercomputer. They are basic equations that can shine a very bright, very uncomfortable light on reports that just don't add up. Think of it as a financial lie detector test, and tonight, we're going to plug everyone in. The problem has always been this. Tax rules are a labyrinth of confusing nonsense. Some people are very, very good at using that confusion to hide their money. They might tell the government they had a terrible year, making almost no profit, while simultaneously buying a third yacht. It's a classic move. For years, auditors had to dig through mountains of paperwork to find the truth. But Dr. Ismuhadi realized you don't always have to dig. Sometimes, you just have to check if 1 + 1 still equals 2, because for some companies, it mysteriously equals yacht. So, what are these magical formulas? They are the tax accounting equation, or TAE, and the mathematical accounting equation, or MAE. That's it. They sound boring, I know, but trust me, what they do is anything but. They work by checking for consistency. Your financial story has to make sense. All right, let's break these down. First up is the tax accounting equation, or TAE. Don't let the name intimidate you. It's incredibly straightforward. Profit a company report should explain the change in its net worth. In simpler terms, what you earned minus what you spent should equal change in what you own minus what you owe. The two sides should match. If they don't, you get a gap. DI-TAE. Discrepancy Index of TAE, the official number for what's weird. Example, imagine a small coffee shop. Owner files a return claiming $5,000 profit for the year. But the balance sheet shows they paid off a $50,000 loan and bought a $20,000 espresso machine. Net worth jumped $70,000. How did $5K profit lead to $70K wealth increase? It didn't. DI-TAE would be massive, a huge red flag. Next, the mathematical accounting equation, MAE. It's slightly more complicated. It brings more items to the formula, including dividends. Full formula. Assets, dividends, expenses should equal liabilities, equity, revenue. Core idea is the same. Consistency check. Good at catching companies claiming zero profit but moving lots of money, like big payouts to owners. Another scenario, a consulting firm reports almost no income. Revenue barely covers expenses, so they claim zero profit. But they paid out $200,000 in dividends to owners. Where did that money come from? MAE asked that question. If reports don't explain the payout, DI-MAE will be huge. It suggests hidden income or a secret stash not on the books. So, why do these simple checks work so well? It's because lying is hard, especially when you have to keep your lies consistent across multiple documents. Financial statements are supposed to tell a single, coherent story about a company's year. The income statement, the balance sheet, the cash flow statement, the TAE, MAE, are like a grumpy editor who reads all the chapters and points out, hey, in chapter 1 you said the hero was broke, but in chapter 3 he bought a castle. Explain that. Now. People trying to hide income often make one critical mistake. They only change the numbers in one place. They might underreport their revenue on the income statement to show a lower profit. But they forget that this revenue had to go somewhere. Maybe it was used to buy a new building, which increases assets. Or maybe it was used to pay down debt, which decreases liabilities. They fix the story in one spot, but create a glaring plot hole somewhere else. The equations are designed specifically to catch these exact mismatches. They mathematically prove the story doesn't hold up. This discrepancy is the bright red flag auditors are looking for. A large DI-TAE or DI-MAE doesn't automatically mean guilty of tax evasion. That's an important point. It could be an honest, albeit massive accounting error. It could be due to complex transactions that were recorded incorrectly. But what it does mean is that the report is unreliable. It signals that the numbers presented cannot be trusted at face value. Think of it like a detective arriving at a crime scene. A broken window doesn't prove who the burglar is, but it sure as hell proves someone broke in. The discrepancy indices are the financial world's broken window. They show that the integrity of the financial report has been compromised. That's the moment an auditor stops skimming and starts investigating. The discrepancy is the trigger. It's the starting point of a much deeper, more thorough examination to find out if it was an accident or if someone has been very, very naughty. So, how does this actually work in the real world? Inside a tax agency, it's all about efficiency. Tax offices are chronically underfunded and overworked. They have millions of tax returns to process, and only a small fraction of the staff needed to check them all thoroughly. They can't afford to spend weeks auditing a company that turns out to be perfectly clean. They need a way to triage to separate the probably fine from the oh dear God, what is happening here? And that is precisely what the TMA indices provide. They are the ultimate sorting hat for tax returns. Here's the process, and it's beautiful in its simplicity. An auditor, or more likely a computer program, pulls the key numbers from a company's financial statements: revenue, expenses, assets, liabilities, dividends, all numbers the company provides itself. Then, it plugs these numbers into the two equations. In seconds, it calculates the DTA and DIMA for that company. There's no deep investigation at this stage, no need to fly agents out to an office. It's all done with the data already on hand, making it incredibly fast and cheap. Once the indices are calculated, they are compared against a predetermined threshold. This threshold is the line in the sand. If a company's discrepancy score is below the line, its file goes into the looks okay for now pile. But if the score is above that line, an alarm bell goes off. That file is immediately flagged and moved to the priority for human review pile. This simple step allows auditors to ignore the vast majority of compliant taxpayers and focus their precious time and energy on the handful of cases that show the most significant signs of trouble. This method also makes the audit selection process much fairer and more objective. It's not based on a random guess, a tip from a disgruntled ex-employee, or an auditor's gut feeling. It's based on cold, hard math. Every company is judged by the same standard. If your own numbers don't add up, you get a closer look. This data-driven approach removes bias and makes the system more transparent. Auditors can now justify their decision to launch a full audit by pointing to a specific, quantifiable red flag. They can say, "We're investigating because your own report has a mathematical hole in it the size of a truck." So, there you have it. Two simple equations have given tax authorities a powerful tool to sniff out financial inconsistencies from a mile away. Dr. Ismuhadi's method isn't magic. It's just a logical check to ensure the story a company tells through its numbers is a coherent one. The tax accounting equation, TAE, keeps an eye on whether reported profits align with changes in net worth. The mathematical accounting equation, MAE, makes sure all the moving parts add up. Dividends, assets paint a complete and logical picture. They are simple, elegant, and incredibly effective. The core lesson: when financial statements are manipulated, it's very difficult to cover all your tracks. Changing one number often creates a ripple effect that throws other numbers out of balance. These equations detect that imbalance. A large discrepancy index, DI-TAE, DI-MAE, is a sign something is amiss. It's the mathematical equivalent of a smoke detector going off. It doesn't tell you what's burning, but it tells you to go and find the fire. For auditors, this is a revolution in approach. Move from a reactive needle-in-a-haystack model to a proactive data-driven strategy. Use these indices as a first-pass filter to screen enormous volumes of data and instantly zoom in on the most suspicious cases. That makes investigators far more efficient and increases the chance of catching non-compliance, helping ensure everyone pays their fair share. Good for the government, good for honest taxpayers. So what's the one clear action? Auditor, regulator, curious investor. The next step is simple. Use the tools. Don't let these equations sit in an academic paper. Implement them. Build a simple spreadsheet or a program that pulls key figures from a financial report and automatically calculates DIT and DIME. Use the scores to rank risk. Start with files that have the biggest, reddest flags. Stop searching for needles in haystacks. Use the giant magnet you've been given. It's that easy.